old enough to remember Rosanna Dana from Saturday Night Live, and she'd come on the air and she'd say, Scott from New Jersey writes in, he has sore feet, swollen ankles, blah, 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 blah. She goes, you sound like a miserable person. It's like, that's kind of like the insurance industry is right now. It is a miserable person. And so it's going to be temporary, I hope, because I've been doing this now for 37 years. We insure about 700 associations all throughout California. Most of Dana Point and Rancho Mirage are 2 offices. And we've been at this so long that we've seen these cycles, right? I saw the Northridge earthquake. And when the Northridge earthquake happened, one insurance company, 20th Century, almost went out of business. AIG bought them. And then what happened was the insurance industry was in a moratorium for homeowners sales, if you remember that, because back in those days, a homeowner's insurance company had to give a mandatory offer of earthquake insurance to a homeowner, right? Every 2 years, mandatory offer. And the insurance industry said, we just almost lost it from Northridge. We can't do this. So they said, you have to do it. There's Department of Insurance. So then the insurance industry said, we're not going to sell homeowners insurance. Homeowners insurance premiums overnight went from average of $600 to $2,400. This is back in 1994. And so basically what happened was the California Earthquake Authority was born. That was a bad, bad time. This time right now, I'm here to tell you, it's 10 times worse than that. Way, way worse. Because it affects not only HOAs, but single-family homes, commercial centers, this office building, like everybody is affected by it, and it's a huge problem. So I'm going to tell you today a few things about why it's happening, and then I'm going to talk about some things you can do as a board member to kind of hedge your bet a little bit and prevent some mayhem that could possibly come your way. And then I'm going to give you one tip that I think is on the radar, and it's a timeless tip because it's a repeated mistake people make over and over. So the current marketplace in California, really we have to talk first about fire insurance, right? We all know about the wildfires that have been going on. In 2018, fire season was the worst on record within California history, okay? That was until the 2020 fire season, and then that was until the 2021 fire season. 9 of the largest 20 fires in recorded history, of state history, going back to 1932. 9 of the largest 20. Okay, so obviously we've had huge fires, and that's no surprise to anybody here. Insurance companies have been paying over and over for that. Here's a list of the top 15 wildfires, and what's interesting to me is this. Look at the red. The red is the cause of the fire. If you look down at the bottom, it's utilities. So what is that? It's an aging infrastructure. Does that sound familiar to anybody? An aging infrastructure causing problems? Yes. And so that's part of the problem here. And not to mention we're building out in the edges of Orange County and whatnot, and that doesn't help, right? And all over the state. It's not just about wildfires, though. It's also about a national, it's really a global insurance market. And so when we have hailstorms, look at Texas. This is just 2023. They had 1,123 hailstorms. Those are very expensive. And then you see the other states there in the hundreds of hailstorms. And then so we talk about wind events. We're talking about, global disasters all over. It's one global supermarket. We also have a major problem with increased costs of construction. I know none of this is surprising to you, right? This is just the 2022 numbers here. We've got copper went up 147%. You've got copper pipe at 74, PVP pipe, it goes on and on and on. And undoubtedly, you've seen this. If you've been on your board for 4 or 5 years, you've seen what's happened with construction prices. What I think is very notable about the situation, as highlighted here on this slide, is that 92% of contractors report moderate to high levels of difficulty finding skilled workers. So the labor cost has gone up, right? And so that's also adding to the problem as well. In fact, if you take a look at some of the announcements from the insurance companies that put out statements saying we're taking rate or we're going to stop writing business, they all reference increased cost of construction. It is absolutely a horrific thing that is really causing massive problems for the insurance industry to properly price. But this is the concept that I think it's really important for people to understand. Now, this is a backroom word, reinsurance. Most consumers don't know what it is. The insurance industry knows what it is very well. And so basically, I'm just going to tell you a quick little story about this. After the Santa Rosa fire, I had a pre-planned meeting with the CEO of a very large insurance company. I probably shouldn't say their name, but it's a household name. And I went and I met with them about 10 to 14 days after the fire. In the conversation, of course, the topic of the day is they lost close to $1 billion of property structures in Santa Rosa. And so it's like, how's it going? Dumb question of the day. And he says, Patrick, it's going okay, actually. We didn't get hurt that bad at Santa Rosa. It's like, wow, that's great news. And he says, yeah, we lost about $250 million, but that's it. Now, they lost about $1 billion of property. So what is he talking about, right? He's talking about the concept of reinsurance. If you go back 350 years ago to Lloyd's of London, when Lloyd's of London was in a coffee shop, and they used to insure ships coming to the New World, and you'd had these investors, now called insurance companies or underwriters, and they would invest on the cargo that was going over on the whatever ship. And so basically it was spreading the risk. It's like this investor would take this much money, this investor would take this much money, and it's like that's how the insurance industry was built. It's reinsurance. So when a big name brand insurance company, pick your favorite company or your most hated, doesn't matter, they all do it. So basically they're going to say, if we're going to insure this much exposure in Orange County, we're going to reinsure a big part of it. Because what if Orange County has a huge, horrific wildfire? We don't want to be out of business. So we're going to spread the risk to our reinsurance partners. What if we insure an HOA with a $150 million total insured value? Meaning, what's the cost of all of the buildings to rebuild? If they all go down in a massive fire, that's the total insured value. What if you lose them? Do you want to write a check for $150 million? No, you do not. You want to have a reinsurance partner to offload a healthy percentage of that. So it's reinsurance. Well, the problem is this. When you have these reinsurance companies coming to the table after Santa Rosa, and then the Tubbs fire, and then the blah, 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 and then, oh, and by the way, don't forget the hailstorm in Texas, and don't forget the windstorm in Florida, it gets to the point where the reinsurance companies have lost their appetite for writing insurance. And that is having an effect now. So very, very often in my office, we will hear about underwriters. It's like, we need the quote for Whispering Winds HOA. Where is it? We're waiting for reinsurance terms. They're struggling to get it. And so that's really the problem. It's a reinsurance crisis. The way the reinsurance companies work is illustrated here. So the insurance company finds a reinsurance partner, and then they go out and they get the insurance company, sells insurance to a consumer, right? And then the insurance company pays a reinsurer for the insurance coverage on the back end, right? So you don't see it. It's part of your premium dollar. And then the customer has a claim. They receive a check from the insurance company they did business with. The insurance company turns around and goes back to the reinsurance company for reimbursement. Okay? That's the way it works. That's what's kept the industry working. So because of the reinsurance issues, because of the fires, because of the increased cost of construction and all that, but really the reinsurance, here are some recent insurance company actions. And these are dramatic. State Farm Insurance, they're in a full new business moratorium. Now, what's interesting about State Farm is that they were writing insurance for HOAs. Maybe this has happened to one of you, where maybe your insurance broker called up and said, hey, you're being non-renewed, but my buddy down the street at State Farm can write it. Because I did that with like 12 or 18 associations, where like in a short period of time, this State Farm agent, I think he was getting me a plaque for top salesperson. Here you go, here's another one, because it was the right thing to do, of course. And so they were writing these policies. Now they're in a moratorium. So it's like when everybody's wondering about God, what are they doing? It's like, well, now they're in a moratorium. Maybe that's the answer to the question. But also, this is dramatic. Okay, this was as of last Thursday. They got downgraded from AM Best to a B. Now, I want to really emphasize what that means. This is not like when I was going to school and I was thrilled with a B. Okay, a B is like a D in school. It's like you're almost going to get. So I want to be clear on this, though, because at first in the insurance community, there was all this misinformation going around. No surprise. It's not your auto insurance that's with State Farm. It's not your home insurance with State Farm. It's State Farm General. It is your HOA that's with State Farm. It's the restaurant that insures with State Farm. It's all the business policies. So they're a B. That means that loans are going to be questioned. If like you don't necessarily qualify for the loan if your carrier is rated B. This is a big deal in the insurance industry. Farmers Insurance, they went to a moratorium, new business moratorium, not non-renewals, 11/1/2003. They also went through a round of non-renewals. All these companies are doing that for wildfire. Nationwide, they're not taking new business. They didn't announce for a moratorium. They're just dead as a doorknob, though. Travelers, they're rewriting from one subsidiary to a more expensive subsidiary. And then, of course, Philadelphia, I'm a Farmers agent. I'm also a Philadelphia directly appointed agent. I have Nationwide as well, but Philadelphia, I love Philadelphia right now. They're really the heroes of it, but they are increasing premiums, and what they're doing is they're recalculating the cost per square foot to be a higher number. They believe it's justified. It's resulting in higher premiums though, right? And sometimes clients look at it and go, that much? And it's like, well, that's what their claims experience is indicating. And so they're trying to keep ahead of it and keep the numbers right for the long term. Some more interesting things about the insurance industry actions. The PUD appetite has really shrunk. Okay, so if you have a PUD, which I think someone said they did already, I'm sure there's more of you, it's just shrunk. If you're a large PUD, it's a bigger problem than if you're a smaller PUD. So just fewer carriers. That's not a deep bench. Large associations, very much grown out of favor. Any guesses to why? Reinsurance. You're right. It's a reinsurance. They can't find the reinsurance on it. I can't insure this $150 million exposure if I can't find the reinsurance partner. So the appetite has shrunk. Umbrella policies have reduced appetite. They're largely reinsured. Earthquake premiums, spoiler alert, also heavily reinsured. They're decreasing their appetite. They're increasing their prices. Older properties, 50 years old, okay? I take offense to that because I'm over 50. But check that out, 30? 30 is now old? Evidently, according to the insurance industry, yeah. Your property that hasn't been updated in 30 years most certainly is considered old. Okay, so we're going to talk a little bit more about that in a second. California Fair Plan. Everybody asks questions about California Fair Plan, so I thought I wanted to just address this. They're really great. It's nice to have them. They're just not super useful at this point for any HOA that has a value, total insured value, not market value, of over 20 million. So if you're looking at an association with maybe more than 80 or 100 units, you're probably over 20 million. California Fair Plan is not an option for you, right? California Fair Plan is also the carrier of last resort, mainly for fire and a couple of other things, right? Not necessarily for the deferred maintenance, although we do see associations going there. The problem with Fair Plan is you need a secondary policy because Fair Plan only covers the basic perils, and then you need water damage. Like the number one claim, I think we would all agree on that, is water. That's the frequency, right? And they don't cover water, so that's a problem. So it really is truly a last resort. Okay, so I want to explain this too. You never thought you'd learn so much about insurance this morning, did you? There's two sides of the street, folks. There's the standard market, and there's the excess surplus. And I know this sounds boring, but this is helpful to understand the problem, okay? So number one, there should be a line here. I apologize, there's not. That's my fault. But on the standard side of the market, we have the companies you all know, Farmers, State Farm, AAA. That's called a standard carrier. They're admitted in the state of California, which means if they go bankrupt, the state is there to protect you to some degree. The Department of Insurance is there to kind of look over their shoulder real strictly, approve everything they do, and it's like, oh, by the way, that claim didn't go perfectly, or even if they say it went horribly, they get involved and they are a consumer advocate, and they're great for that. The thing is that the insurance companies on this side of the ledger, because their rates are regulated, if they start losing money, they have no choice but to pause the business. Because if they're charging you $20,000 for an association and they think they should be charging you $30,000 to make that profit, if the Department of Insurance says, no, you're only going to charge 20, then they have no choice but to say, we're out. Okay? Now, put a pin on that comment and let's go look at this side. Okay? The other side is excess or surplus. There is no admitted carriers in excess and surplus, which means that you have no state guarantee fund. So if they go out of business, you got a problem, right? So you have to stay with really strong companies. Number two, they can charge whatever premium they seem fit. So that association I just mentioned that pays 20 and maybe 30 is really the number we need, and the standard company can't get there because DOI says, no, you can't do it. Now here comes the excess and surplus lines company. They'll do it, but guess what? They're not going to do it for 30. They're going to do it for wherever they think they can. Maybe it's 70. And here's the problem. Everything on this side typically is more expensive because there's no regulation on it and they're charging what they perceive is the correct premium. So the point I'm making on this is if you go to Florida where they have a lot of wind claims and whatnot, most of the HOA market is insured in two categories. It's insured in their equivalent of California Fair Plan, and it's insured in excess and surplus lines. So their premiums generally are about 3 times higher than what we have in California. I am here to tell you that I am afraid, as a long veteran in this business, I'm afraid that we're going to see more associations migrating to this column, okay? And I'll tell you why. This in next few slides we'll see here. Number one, new reliance on fire maps. Is anybody here in a wildfire? Because this could be a whole day talking about it. Yes, you are? Yep. Okay, so here's the deal. This is the wildfire map. This happens to be Portola Hills, one of my clients up there. And this is one of the popular maps. This is a 71 score. Bad, okay? The insurance is very difficult to get. They're in excess and surplus lines for sure, okay? And I want to show you this. So if you look at this right here, let's just suppose for a second that this was not here in the 71. Let's say it was in this green, if you can see that far. Green would be under 50. And you're like, hey, you're good. You're under 50. 50 is great, right? 50 and under. Here's the problem. The problem is that all this red that surrounds it, the underwriter is worried about the wind carrying it in. And here's why. This is Santa Rosa. This is Coffey Park in Santa Rosa. There were hundreds of homes in this neighborhood. Hundreds of them burned down. At 11 p.m. on a Sunday night, the winds kicked up. The hills around were all on fire. The wind kicked up and started throwing embers into the homes. And by sunrise, this is what you had. And this is a really docile picture, actually. There's entire blocks. They're just charred as if they were bombed overnight. So here's the vinyl fence. Here's the vinyl fence. The rest of the house is gone because the fire blew into the community. So it's a major problem. I could talk about wildfire seriously all day, but we don't have time to do that. So there's a whole bunch going on with wildfire. If you want to talk to me offline, I'd be more than happy to talk to you about it. Going back to things that everybody has in common, some renewability issues. So premium versus claims, that is certainly one issue, right? You've got a situation where you've got to manage, and I'm going to show you a few things to think about today, but basically you have to manage your premium to your claims, okay? Your property conditions, this is a barbecue. This is one of my clients. Gentleman was barbecuing. He started eating dinner. The wall had heated up. As he's eating dinner, it's like, what's that smoke doing? Oh, it's just a $300,000 fire. That's all, right? You folks, please get the barbecues off of your balconies. Keep them, the state law is 10 feet from combustible material. And I know it sucks, and I know I'm a party pooper saying that, but you have to do that. If you have a barbecue fire on an otherwise spotless record, it's going to be frowned upon in the insurance industry. Oh, great, a barbecue fire. When's the next one? I got to tell you, if we could get every candle out of every unit, I would be super happy because candles burn down so many structures. It's unbelievable. More than smoking, by the way. Maybe that's a function of people don't smoke as much as they used to. This is another one that's really, really important. Zinsco panels. If you have Zinsco panels, I would do two things. Or actually, Federal Pacific Stab Block 2. Here's a photo of that. So either one, do two things. Number one, keep your head down with your insurance carrier. If they don't know about it, hopefully they don't find out about it. And there's no problem with that, by the way, because unless they ask you, do you have these panels, which you've been insured for them for a long time, they didn't ask you that. It's only been a recent question. Then you just want to let it go. But the second thing, and I mean this, get a plan in place to remove the panels because it will catch up to you. I have associations, many that have gone from paying $40,000 or $50,000, and then we find out they have Zinsco panels. Maybe they get non-renewed for some other reason, and then we ask the question now, do you have these panels? Yes, we do. And you have to answer the question honestly. The new premium for these is goes from $40,000 to $400,000 or $500,000. And the coverage goes way down. So get the panels out. Okay, the other thing about it is railings, okay? These railings, see these ladder effect railings, the horizontal ones? That's a problem nowadays, so be careful of that. If you have those, just know you're going to pay a little bit more money for it. Some companies may make you ineligible for it, but if you're designing the new railings, don't go horizontal. I know they look great, but they're a problem for insurance because of the ladder effect. The other thing is, keep in mind, railings 4.5 inches, okay? I'm a pretty casual guy on loss control stuff. I mean, sort of. But I will tell you, I've gone to some associations where I look at railings that are 6 inches wide, and then I look at the drop, and I was like, oh my God, it's just wow, what is happening here? This is like a foreign country. How is this happening here? It's really a problem. You need to know that people are really having a problem. Underwriters are having a problem with these railings because of kids just slipping right through, okay? And please don't tell me, well, we're 55 and over. They're like, yeah, you don't have any grandkids? You have any nieces and nephews? It's a problem still, okay? Loss control. This is something where you would get a loss control rep to come out. Maybe the board meet them. Usually it's the manager. Or the manager says, hey, just go for it. You don't need any media there. Just go for it. Then they send this little report out. And this report says, hey, do A, B, and C. The insurance industry has been very notorious about very loosely enforcing those things. Like if you didn't have a fence around the pool, they were all over it. But if it was like, hey, maybe you should consider doing this or doing that, cut the trees back from the eaves, they were casual. They're not casual anymore, okay? So the insurance companies that I deal with and multiple underwriters, they kind of say all the same thing. We want a good partner in a client. What does that mean? We want a partner that when we say, hey, trim the trees back, we want the partner to say, okay, or no, we can't do that because of X, Y, Z, but we will do this. We'll make a plan to get it done. Anything is better than ghosting them. So when your agent is calling you and saying, I need the loss control, I need someone to sign it, please take that seriously because at come renewal time, this could be a big hiccup in your pricing and your eligibility, really. The other thing is the total insurable value. Kind of mentioned that already. High values are tougher. You can't do anything about that. You can't do anything, so don't worry about it. Renter ratio, you can't do anything about either necessarily, but just know that as we get more and more renters in communities, the underwriters start looking at them condos as apartments, and they're more expensive. So higher renter ratio is a bit of a problem. Water intrusion policy. This is something that is really important, and just I want to mention it because it's in one of my recommendations for you. How many have water intrusion policies? Not very many. Okay, great. That's good because you can all walk out with like, this is something you can actually do. Get a written water intrusion policy. I also like to call it a claim procedure policy, which means that when a claim happens, what happens next? Now we focus on water because it's the number one frequency, right? But it also applies to fire. Who's going to do what? What does the management company do? What does the board member do? Not the board member, the homeowner do? And what are the CSNRs required of the association to do? Who pays that deductible, right? Is it really vague right now? I mean, deductible is going up. Used to be $1,000, now it's $5,000, could be $10,000. Maybe you have a $20,000 deductible. There's split deductibles, which I'll mention. And so basically a water intrusion policy will spell it out. But here's the great thing for board members. It will eliminate the stupid, well, maybe not stupid, the very worthwhile conversations you have with a homeowner who can't understand why you're not responsible for their couch, okay, when clearly you're not, right? So, but it it basically spells out everything. So now the person comes to the board meeting, they go, hey, you know, this happened, blah, 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 blah. It's like, well, here's our written water intrusion policy. And it's all laid out for us. It ends all the arguments, okay? So your attorney writes this up for you. It's not like rewriting your CC&Rs, so it's not that big a deal. And it's really worthwhile for you to do it. I would talk to all of your general counsel about getting one. Okay, so some preventative measures. Number one, manage your loss ratio. What does that mean? Sometimes you can't avoid a fire, right? But maybe you have a $10,000 deductible and you get a $13,000 water claim. Maybe it's a good idea to say, you know what, insurance company? Thank you for adjusting this claim. Don't pay us the $3,000. We're going to handle this internally because we want to manage our loss ratio and make sure we keep our claims down, right? Warning, that does not mean that you make the homeowner responsible for that $3,000. If the homeowner has a right to a benefit, they are to receive that benefit. That means the association writes that check to $3,000 to the homeowner. So don't blow that second part because you'll get sued and you will lose if you're truly responsible for that amount of money. Number two, deductible strategies. I love going higher deductibles. Keep in mind, we're not talking about putting your neighbor with a $10,000 deductible. Nobody here expects the neighbor to write a check out for $10,000. What we expect is the neighbor's insurance company to write the check for $10,000. It's all insured under the unit owner's policy, which is called an HO6, which I'm going to show you in a second. It's all insured elsewhere. Shift the risk from the association to the unit owner's policy. Your job is to protect the association, and it's better for the association to have that happen. Keep up with your deferred maintenance. Probably sounds pretty self-explanatory, but that is super important. Insurance companies are looking at deferred maintenance. Have a plan to replace aging infrastructure. That's speaking of like the Zinsco panels. By the way, the Zinsco and Federal Pacific Stab Block, those are mostly 1970s year construction, mostly. So that's one little tip for you. You want to reduce your trip fall hazards. Obviously, this is something that we all know, right? Grind down those sidewalks, close those gaps and whatnot. Trip fall, by the way, is the number one severity claim for liability policies. We have multiple multi-$100,000 claims, $1,000,000 claims. We've had death claims. So yeah, trip fall is the biggest issue from a liability standpoint. Establish the written intrusion policy, or as I like to call it, the property claim handling procedure. That's new, by the way. I just thought of it, and I want to make it real trendy in the industry, because that's really what it is. It applies to fire, it applies to water, it applies to any kind of property claim. And then also lean on your professionals to keep the HOA out of contentious D&O matters. I can't tell you how many times the board of directors just really, they mean well, right? And I love board members, and they all, by the way, your neighbors all owe you a debt of gratitude of thanks. I know you don't get it, but really, the pay sucks, but the responsibility is really noble. And so good for you for doing that. But at the same time, some board members will kind of go down this path, and they won't, maybe they'll just kind of push over the manager, and they go, no, 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 let's do it this way. And it's like, no, 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 no. Call the attorney in. Call your insurance broker. Call your architect. Like, figure it out with your professionals. Don't put the D&O problem in this rabbit hole where all of a sudden you have a big directors and officers claim. And by the way, I apologize. I should define directors and officers just so it's perfectly clear. Directors and officers is for board member liability. So somebody comes to you and says, my neighbor won't shut up. I'm demanding you do something about my neighbor. If you don't do something, or maybe you do something wrong, you could have a D&O claim. Here's a claim. Here's a claim for you. This is a real life claim. The board is concerned about the kids playing, like kids do in the common area driveways. And they say, hey, it's October, the sun's going down at 5, people are coming home at night, and they got these kids riding all over, like we all did. So they said, no children playing in the common area driveways, thinking that they were going to save a life or an injury, right? Well, they got sued. They got sued for the fair housing because children are a protected class. You can't say no children. So what they did was they paid the person $60,000, the D&O, Director's Officer Policy paid $60,000. What the change to the procedure or the policy was is they took that sign down and they put up a new sign. And that new sign said, no wheeled amusement devices in the driveway. And that's honest to God true story. Because a wheeled amusement device is not a protected class, but a child is. So that's another example of directors and officers. We have probably, two D&O claims filed in our office every week for sure. I'm probably under, for sure too. It's a very common thing. Now, they don't all blossom, but you have an obligation to notify your insurance company, hey, somebody made a demand on us. You're required to notify your carrier at that moment. Whether it develops or not, you're required to notify them. If you don't, they can pull coverage, so be careful of that. So that is my advice for the preventative ideas. I also really want to stress members need to be educated, okay? So what does an HO6 policy cover? We talked about it earlier a few times. Super important, obviously. It covers personal property. It covers your building interior. Now look, you could have a bare walls policy, you could have an all-in policy, you can have a walls-in policy, radically different coverage. And today's window is a little short, so we're not going to go too far into that stuff. But it makes up the difference. For instance, let's say you have a policy where your association covers just your drywall. Who's going to pay for your cabinetry and your flooring and all your light fixtures? Your HO6 policy picks that up. What if you have a walls-in policy and they come in and they go, hey, that hardwood floor you put in 5 years ago? Well, when the developer built it, it was tile. So here's your allowance for tile. You pay for the difference out of your HO6 policy. Okay, so it's super important to know what you need. And so continuing on with that, and I'll get back in a second, you got liability insurance. You hit someone over the head with a golf club, your water heater completely drains and it floods out your neighbor's unit. That's a liability claim against you, right? That's on your HO6 policy. Loss of use. You have a fire. Where are you going to go? Well, the insurance company hopefully is going to pay you, and that's under loss of use. And then you have my favorite, loss assessment, especially for the wildfire-prone communities. If you don't have enough insurance or you have really high deductibles, loss assessment is the key word for those things. The way it works is you have an insured event, like a fire, and there's not enough insurance, and then everybody's going to get assessed their amount of money, and your loss assessment on HO6 is very inexpensive, very useful for times like that. So loss assessment is super important. Here's our version. Now, I'm not the only one in town that does this, right? There's probably, I don't know, but there's probably like 10 or 15 insurance brokers in Orange and LA County that really specialize in HOA. And what I mean by that is like an agent that has maybe more than 50 HOAs insured, right? Not very many, right? And so my friends and competitors and whatnot, they all have their same version of this. This is ours, and basically page 1 goes over what the association policy covers. It's got a little highlight here of how you might be responsible for your association deductible. Think about this. Page 2 is exactly what you can do. You can send this to any insurance. First of all, anybody can read this and understand it, I believe. But certainly if you send this to your insurance agent, they'll know exactly what you need. It's just a little checklist. And I send this out once a year. I don't send it out. I give it to the management company. Management company sends it out. Whether they do or not, I don't know for sure. Most of them do. And it's good. It's good to send out. Maybe you send it out with your annual insurance disclosure. It's like, hey, look, because the more you educate your homeowners to have their own HO6 policy, the easier the claims are going to be. Okay, now, so on the tip I wanted to mention, okay, this is a fire that I was part of. I insured this master association I'm about to show you, but I've been talking about this for years, which is trees and outdoor property. It is notoriously underinsured in my industry. So this is a fire started like behind Ben Brown's golf course. This is 2022. I'm sure you all heard about this fire. It destroyed real big, large homes. I almost said multi-million-dollar homes, but what isn't anymore, right? But these like really expensive homes. Anyways, it burned a lot of their landscape. So you see here, this is acacia, real popular in the 90s, right? You might have it. Look how it burns. It's here and it's here. It just burns like crazy. The homeowner across the street from this came out, hey, what's going on out here? There's a fire. And they opened up their garage door. The fire ember went into the garage, torched their house. The only house on this particular block that was burned down. Everybody else was at work and didn't have their doors open. So this is a slope. All of this, actually, I think I have one more slide here. Yeah, see all this ash? The insurance company had to pay to have this ash removed, okay? This was hundreds of thousands of dollars in expense. And then you've got here, any wild guess as to what that little thing is, if you can see it very well? It's metal. Any ideas? No, that's a good guess though, not a mattress. It's a sprinkler. Your sprinklers will melt and you'll have a little spring. All of your plastic piping will melt. I'm here to tell you, if you have an insurance policy and you're paying $10,000 a year, if you crank up your outdoor property in your landscape, that premium of $10,000 is going to go up to a whopping $10,400. But it's going to make a huge difference come claim time. I mean, really, truly, I'm exaggerating. No, I'm actually not exaggerating. I'm making this premium up. I don't know if it's really $400. It's going to be cheap. Like, nobody will think twice about it to radically increase your plan. The problem with the wildfire accounts is that it's limited from the insurance company. They won't let you increase outdoor property. Why? Because it burns. So that's the problem. So if you're not in a wildfire area, I would just increase that. It's going to be a really, really small bite in your budget. You'll be way better off to have that.